This video is all about money and the central banks. Please note that I will be going through the material here in a somewhat different order to the LOS list provided by CFA Institute. First, we are going to describe the functions and definitions of money. Okay, so what are the functions of money? It is a store of value, so we can hold on to an amount of value for use at another time. It is also a medium of exchange, which has proven to be a little bit more practical than a barter system. And it is a unit of account, so we can use it to compare values. What about the definitions of money? Well, first we have narrow money, which is basically anything which is not earning interest. So we're talking about currency in circulation and bank deposits. Then we have broad money, which includes all of the narrow money, and it also includes assets which are a little less liquid than currency in circulation, but are still immediately spendable. Now, between the US and the Eurozone, M1 is the general term for the most liquid form of money. From there, though, we see some differences in how broad money is broken down. In the US, savings accounts and time deposits are in M2, whereas in the Eurozone, we get breakdown of deposits and repos and money markets and assign them between M2 and M3 depending on their liquidity. The key to this LOS is the understanding that the definitions of money are based on liquidity. Next, we must explain the money creation process. This is all based on the fractional reserve banking system. Under this system, when a bank receives money in the form of deposits, they are not required to keep 100% of that money in their vault for safekeeping. They must retain a portion of it as reserves to fund withdrawals, but they can take the rest and lend it to a borrower. The amount which they are required to keep is determined by the required reserve ratio. If the reserve ratio is 10%, then for every deposit they receive of €100, they are required to keep 10 and can lend out the remaining 90. So be careful now about how this relates to the amount of money created, because it doesn't stop there. Once a borrower has taken the €90 which the bank has loaned to them, they will go out and spend it, and whoever they pay the €90 to will go back to the bank and deposit it. So again now, the bank needs to hold on to 10%, but that will leave them with €81 more to lend out again. Overall, the net effect of this process can be very simply stated. The deposit expansion multiplier is given by 1 divided by the reserve ratio, which in this case is 1 divided by 10%, which is 10. The potential increase in the money supply then is given by simply multiplying the deposit coming in by the expansion multiplier. So in this case, for a €100 deposit, just multiply by 10 to find the potential increase in the money supply of €1,000. Remember that people can use different banks, and maybe some people will hide their money in the curtains, but here we are talking about the potential increase in the money supply across the entire banking system. It's not going to be an exact science in reality. Now we are going to move on to central banks. Firstly, their roles and objectives. Now the first and most obvious role of a central bank, as we have already discussed in this section, is that they are responsible for implementing monetary policy. They have control over the money supply and credit markets, which they can use to stimulate or restrain an economy as the needs come about. Next, the central bank is responsible for both domestic and foreign currency. They are the only body which can issue domestic currency, and they administer the holdings of foreign currency reserves held by a country. After that, they act as a provider of banking services to the banks within a country and that country's government. And lastly, they help to regulate the banking system. Now, obviously, the regulation of a banking system has a few more players on the board, but they do have a part to play in there. In terms of goals, the main goal of a central bank is to maintain price stability in the market. They are responsible for keeping inflation under control and ensuring that the supply of money circulating in the country is appropriate. As well as price stability, some central banks will act to promote full employment or stimulate a contracting economy, or they might try to stabilize exchange rates with other currencies, which is called exchange rate pegging. For a central bank to achieve its goals and effectively influence the price stability within its jurisdiction, it must have 3 major qualities: transparency, independence, and credibility. Firstly, they must be transparent. They need to freely discuss the reports and indicators they use and how they interpret them. They must periodically release reports on their interpretation of the economy and inflation levels so that we can anticipate their actions. Secondly, they must be relatively independent. We don't need them to be completely autonomous and isolated here, but they do need to be credibly removed from political bodies influencing their decisions. Operational independence means that they are responsible for setting the policy rate, the rate at which they can lend money as a lender of last resort. And target independence, which means that they are responsible for setting targets and timelines for inflation. When government starts to assert some kind of authority in this area, that's when a central bank loses its effectiveness. Finally, then we need credibility. For a central bank to be effective, they need to clearly state their intentions and commit to those intentions with action. If a central bank commonly makes claims about their intentions and then acts to the contrary, their ability to effectively apply their monetary policy will be severely limited. Now we are going to contrast the various types of targeting used by a central bank to gauge the need for them to take action. Firstly, inflation targeting. Generally, a central bank will aim to keep inflation somewhere around the 2% mark. Now, obviously, they want to keep inflation positive. They do not want deflation, but at the same time, they do not want to allow inflation to rise above 3 or 4%. For example, when inflation is below the target band, they will increase the money supply. So that will stimulate the economy and raise prices to get inflation back up to the target range. The next type of target they have is the interest rate target. Now, with interest rates, similar to inflation, central banks will generally have a target band that they try to maintain. When rates fall below the range, the central bank will reduce the money supply. By entering the open market as a seller of government securities, they remove cash from bank accounts and prices will fall so that rates will rise, bringing those rates back up into the target range. Finally, then we must look at exchange rate targets. This is usually the case for an underdeveloped country trying to attach their currency to a more stable currency. When our domestic currency is above the target range, we sell it, driving its value down. When our domestic currency is below the target range, we buy it and drive its value up. Buying currency can reach a limit though. We need to have a stockpile of foreign currency reserves available if we want to buy our own domestic currency. Now, if the central bank is successful in pegging their exchange rate to another currency, our domestic inflation rate will equal the inflation rate of the country we are pegged to.